It is Phil Racklin with Rebel Financial, and thanks so much to joining us for our live broadcast. Today we've got something near and dear to us. We're going to talk about portfolio design, investment management, modeling, and even though these things sound really complex, we want you to just understand a little bit more about how we help our clients take care of their investments, and how even if you're doing it yourself, some of the concepts that we're talking about are super important to you being successful. So let's dig right in. We're going to be a lot of meat and potatoes in this episode. So we're going to show my screen up here so I can walk you through some things. And the first thing that I really like to go over is what is the reality, because a lot of people don't even know what the reality of the investment landscape is. So you saw on our main website right there, we have a brochure that you can open, and I'm just going to show it to you this way because it's really easy. If you want to follow along or look at this later, you can bring it up. But if you go down to the 5th page right here, I'm going to go over a couple of white paper studies that a couple companies, Dalbar and Vanguard, have put together so that people can really understand, where are investors? And these studies, to a certain degree, especially the first one, it's everybody kind of retirement-wise. So professionals, DIY people, everyone just kind of lumped together here. How well have people done over time? And so when you're looking at this graph, you can kind of see how well people have done when they pick their own aggressive investments in there, how well they've done when they pick their own conservative, and you can match that up kind of to the S&P is a good proxy for looking at the aggressive, and the bond index right here, we call it the Barclays Aggregate Bond Index, or the AG, some people call it. You can compare the conservative fixed income to that to get a baseline of how well did people do over these different time frames after cost compared to what a lot of people would say the average is. Now, we argue a lot. These are not the averages of how well, what you should, compare against in terms of like what the average person is doing. Obviously, we can see that there's a massive underperformance. I mean, we're talking, depending on the time period that you look here, 3 to 6% per year. It's pretty catastrophic in terms of how much wealth should have been created to what in actual was created. And of course, there's some people that don't like this study because they'll argue that people that are saving on a contributory basis going forward, it's not a fair comparison, comparing against the indice. And you know what? To me, that's kind of academic because it is what people are actually getting compared to what the markets did, right? And so maybe some of the timing of how things went in there influence, you could even say as much of a quarter or what. So, but still, there's still a massive underperformance there. I don't think we can argue that. And so, why does this happen? And a lot of it is because that people do not build good portfolios. They do either, just from a scientific or academic perspective in terms of how should they put their eggs in different baskets, or from the behavioral or the psychology side of things, to build something that's good for them for what they need. And then, of course, when something bad or when the markets are really taking off, they weren't prepared to handle that situation from a behavioral standpoint, and they shoot themselves in the foot. So the second one I'm going to just go over here real fast. And there's a longer white paper that Vanguard put out about it. Both of these I kind of clipped the portions that I want to just show the data faster. But again, I've footnoted them. You can look them up if you want to see the entire paper or what. So you can Google it. But Vanguard a couple of years ago, came out with this piece saying, if you really did do all of these things, or if you had an investment advisor help you with all of these things, what's the value of that? Between building portfolios, making sure you're controlling costs, rebalancing, making sure the strategy and how you're going to withdraw from that investment strategy works well, and then also just behavioral coaching and sticking to your plan. You add that all up, and it's like 3% per year. So I mean, these are kind of coming at it from different angles, but it's telling a lot of the same story in terms of like what's the value and why are people underperforming, and the reality that people really are. I think if you went out and asked someone, do you think you did as well as the markets, and they're like, yeah, I'm at least average, hopefully. I'm better than average. I think that is a very American thing to believe that and to want to believe that. But obviously, from looking at those numbers, the reality is a lot worse. Okay, so let's look at this. I'm going to do this real fast because this is not the total point of. I could have a whole different live broadcast just on this one piece that DFA puts out in terms of, how should you invest if you don't want to be speculative. If you're not betting on the future that some niche outcome that you're trying to predict based on how you see the world, or some articles you read in Wall Street Journal or whatever, if you say, I want a very good strategy that over a long period of time has a very high probability of doing well for me, it's like 1, 2, 3, 4, 5 steps inside of here. And basically it just talks about the markets are efficient over long periods of time, and you should not try to beat the markets. It is a loser's game, even for professionals. And then it just goes to show how many professionals have outperformed the markets over longer periods of time. So in this case, 15 years, and less than 20% of them did. And what's even more alarming to that, because some people might say, well, it's still 20% outperformed, is that in the net, if you broke this down into the first 10 years and the next 5 years, of those 25% that had outperformed in the 10-year period, only 28 outperformed the next. So even if by some, miracle, or more than likely, those people are just outliers, they are outperforming, we have no way to predict who they are ahead of time. And so it makes it irrelevant whether they can do it or not if we can't predict when to get in to their investments ahead of time. So I think this data, if you really take it in, absorb it, think about it, just tries to show you are not going to pick winners. And if you try to, it's like going to the horse races or the dog races. It's gambling. Okay? We don't want to do that. We want to try to get the lowest investments we can, and we want to have our eggs in different baskets in the smartest way possible. And another thing is there's hundreds of books out there over the years of people having these investment strategies of how they think they figured things out. But really, there's only 7 things that have proven over multiple market cycles that happen consistently. That your stocks will outperform your fixed income, will outperform cash. Smaller companies, in general, will do better than larger companies. Value-oriented or buying things on sale, kind of like Warren Buffett and his teacher Benjamin Graham did, are going to do better than growth investments over a long enough period of time. And this one sounds pretty common sense, but it's a little bit more complex than I'm going to leave it on the surface. But companies that are consistently more profitable than others over time will outperform as well. And that's the stock side of the thing. And then on the conservative side of thing, then it's basically the longer term you have. Generally, you take a long enough period of time, you're going to make a higher interest rate. And the more credit risk, or the potential that someone could default, the more interest they have to pay you. And thus, if you do good research to make sure you're not making bad investments, then you're going to make a little bit more for assuming that extra risk. That's it. That's all of the 6 things that there are that consistently are going to provide value to you over the market in general in time. And so the irony is, I'm just going to skip ahead here, is that putting these different eggs in different baskets, the system works better than any of the individual pieces together. And that also folds into our own behavior and psychology, that smoothing out the path and not taking as big of a ride to where our emotions take us from optimism to elation to nervousness to fear drives us to making very suboptimal decisions. And generally headlines lead people into trouble. That short-term mentality of markets and investing is super destructive to people over time. So, that's my little really fast, super intro to how should you build portfolios based on science. And really, if you're going to be a professional, and really, if I were you and it was my money, it's the only way that I would want to build portfolios to invest as well. I don't build things different for how I invest my or my family's money than I do any of our clients, and it's all based on a lot of the research from great thinkers throughout time that have really figured out how can we look at the data, how can we use science to help us. This is not a space for Leonardo's and Da Vinci's and Michelangelo's. Investing is science, okay? And if you can't prove it, it's probably not true. And don't fall in for people that say that they've got this new thing and they're better than anyone else, and either probably it's a recipe for losing money generally, or at the very least underperforming the averages over time. So let's look at where do we go from there. If we went with all the science, then the science would say that we should be as aggressive as possible, and we should do some of those, putting those eggs in different baskets in proportion. But we should all be really aggressive. And again, that is another trap that people fall into. They'll read this article and say, well, I'm young, that means that I should have 90 or 100% in stock, and then I can do this math of my age minus this, and that's how much conservative I should have in there. And absolutely not. I mean, is that a decent guiding rule if you're totally unemotional and you've got nothing else to go by? Possibly. But again, we're human beings, we're not computers or machines, and so we have to take into account how we feel about things. How do you feel about how you save your money? How do you feel about how the markets change? How do you feel about how and where interest rates are? And, how do you feel secure to make good decisions with your money to where you feel safe? Because one of the things that I always tell my clients, there are a lot of great things that our emotions are good for in our lives, and it is a lot of the human experience. But emotions and money, when you interact those two things together, it is a recipe almost always for bad decisions. And so we have holy, so that we know that we are conservative enough that when really bad things happen, that we are or on the flip side, when other people are losing their heads, when things are really going up, we're going to trail off with the protection that we get, and that over the long term we'll still come out ahead because the science says. We use a lot of tools to help our clients in different ways quantify what type of risk taker are they. So this is one that we use called Riskalyze, and we have our clients take, and it gives us a score somewhere between 0 to 100. It's not really a bell curve. It's more linear, I'd say, in that, or at least fat tails. And so it really helps us, classify where people should be. And then we can even beyond just saying you're aggressive, or you're conservative, or you're moderate, or you're moderately aggressive, or in this case, giving risk numbers, we can help them model. We can model out and say, a portfolio like yours, during, the last, half a year or what, so this is what it looked like. If we want to look at the benchmark down here, being a little bit more conservative, that's what it looks like. If you're more aggressive, that's what that looks like. And then we can actually look at long-term things, because people are so focused on the short term and say, if you're invested like this, regardless of what happens in the short term, almost 95% of the time over a 3-year period, based on historical, like what actually happened, you would have been positive. Over a 5-year period, as long as you just follow the strategy, there's no precedence for a negative rate of return. And so, understanding these things helps you deal with them when things happen. And so we look at stress testing to say, this 78 is pretty much, if you were just to take the S&P 500, how aggressive it would be, 78. And this person's moderately aggressive, and their number is 65. So if the markets were up 32%, they would only be up 26.2. If 2008 happened again, and we're just looking at the bear market, kind of the worst kind of 1 year period there, the markets were down 38, and this person would have been down 31 and some change. Going through the whole down and up, like a year and a half there, 3, and this person would have been down, almost 44. And so you start asking, what's to happen? Could you hold on for that? And then, if they say no or yes, or they even want to be more conservative, you say, well, what you're giving up to do that is to lag behind the markets on the upside this much. Is that acceptable? And I think it's very important to accept this ahead of time, not to only have a bare minimum of understanding of what that means, but to actually look at it. This is another test that we run on portfolios so that people can really get an idea of what's the potential way upside or the potential downside kind of in the worst case scenario, and then looking at some things in terms of, well, how aggressive is how I'm investing compared to the S&P? and how much of the upside will I capture? I know some of these things, when you look at them, look very complicated, but I'm trying to explain it. So listen to my words, not just looking at the pictures. Isn't too complicated in terms of what should we do. And so, we can run all kinds of portfolios of showing someone, what is, the difference of how you're invested compared to a different standard. And so, let's run this one just real fast. I'm just going to give you an idea. But these are some of the things that a lot of people wouldn't think that a financial advisor does, that we do, because one of the most important things is making sure that our clients' investments line up with what their goals are to what their expectations are. Oh, that's not the right one. Let's go back and get cash, let's say, qualified. Let's just go down here. I would choose the moderate. It's a little bit more conservative than this person, and you'll just get the idea. And we can run this report to just show them, well, here's the next step down, or here's the next step up. And we can really see, is that what this person wants? So 41%. Well, what if we took the next step down? You'd only be 28% down. But when we look at the markets being up 20%, here you captured almost all of it, but you might be 6.5% behind to have this safety on the downside. And when we make these pacts with ourselves, we understand it, we're a lot more likely to follow through. A lot of times when we make mistakes in our lives and investments and financial planning, it's more because we're afraid of the uncertain. We don't know. And we're afraid of the unknown. And to make these things known, to know that we build things based off of data and science, that we can predict not what's going to happen in the future, but when those scenarios do happen, whenever they do, approximately what's going to happen, this provides the certainty to have those good investment outcomes. So, I'm going to wrap it up because I don't want to make this too long. Feel free to reach out to us. We're more than happy to demo stuff, do an investment or portfolio analysis for you. If you've been a DIYer for a long time and this intrigues you to kind of see some of these things, more than happy to do it for you. But I want to leave you kind of with 4 things, is that we do need to invest. I mean, you look at what cash and CDs and stuff pay compared to inflation, and we've got problems if we don't invest. And that doesn't even take the societal side of things into there. When we invest, we're providing capital for the human race to do new things, to build things, to progress. So not only do we need it to grow for ourselves, but we need our civilization to grow and things to continue to get better. So we need to invest from multiple perspectives. It's very important. But beyond that, we need to understand what we need to accomplish by investing. I mean, is it for your kid's college? Is it for your retirement? Is it you've done well enough that your retirement is a done deal, but if we did do things properly, there would be more to give to charity or grandchildren or whatever you want to do. We need to understand what you need that money for and how it's going to serve what you want it to. And then you need to build your investment strategy in the portfolios that underlie that to suit that. And then lastly, to understand what it means, to be prepared for when those monsters of emotions are going to come up, either in a good or bad way, when the markets are really up and going crazy, bubble-like stuff, or when they're really down and, there are all the chicken littles out there telling people that the sky is going to fall. These things, even though they are the biggest things, are pretty irrelevant to a long-term strategy besides to rebalance and take advantage of them. But unless you have the confidence of understanding your investments, how they're going to act, knowing that you built that right, you're not going to have that confidence. And the last thing is kind of a sub one of the other, is, if you're not prepared to do that yourself, just some of the things I was showing you in the beginning, it very much is worth it to hire a professional. Go to napfa.org, look up an advisor that's near you that can help you understand and build things out, not to just picking, like we said, that magical artistic best investment, but to build portfolios that are going to accomplish what you need to happen in your life to where you can have a good standard of living, to where you're not losing sleep at night. So I hope this was a good live broadcast. I wanted to do something kind of practical. I think it can help those that like to work with planners and advisors, along with a lot of do-it-yourself type people. So again, reach out to us anytime that we can help. Hope you guys have a super finish of the week. Hopefully we're close to spring, and we'll see you next week. We have a great guest coming in, Frank Glover. He actually owns his own home inspection company, and I don't think a lot of us think about that until it's something that we have to get, but there's a lot of proactive things that you can do, and I think it's going to be super to listen about how he runs his business, how he helps homeowners, etc. So tune in for that, and have a super weekend.